Okay, good morning. It is Monday the 3rd of July. Hope you all had a great weekend. Just getting straight down into the briefing then, and a bit of a recap first of all of the previous period that we've just had, so the month of June, a review of kind of how assets performed during that particular month. Then we'll look at some of the weekend's news and we'll have a look on the charts as well and how things are sitting at the moment, and then a forward looking for the rest of the week. Some things obviously we need to look out for, namely we have a US bank holiday, the 4th of July, so one of the biggest US market holidays. That's taking place on Tuesday, which means the markets generally will be quite quiet in the US, both later this evening and then also in particular on Tuesday. But just having a look firstly at the month in review, and this is total return performance of major global financial assets in local currency terms for June of 2017. And there's a couple of interesting things here that have developed over this 4-week period that really tell a bit of a story about how some of these financial market instruments have performed. And that is, well, for one, the biggest one that really sticks out here, and one that obviously we don't really look at too much directly from the assets that we trade here at Amplify, but wheat. If you look at wheat over the course of the 4-week period of June, it's risen nearly 20% in local currency terms. Well, terms, I should say. So who can tell me then in the chat, why had wheat gone up so much? What would be a pretty clear variable, even without knowing specifically? What would you say would be probably a likely contributor to wheat jumping about 20%? If you think about softs, what would be probably the most variable that would have the biggest impact? Yep, so you guys got it right on the money. The weather and a drought that is happening at the moment in North America, having a severe impact on the price of wheat. I think it's in terms of the actual quality of the land at the moment, is in the way it's measured, is the worst in over a decade. Is some of the things that I've read more recently. A bit of context. These are sort of things that if you were an agricultural or a softs trader, you'd be monitoring these weather patterns quite closely. This is the US Drought Monitor, and this is Dakota, the area here in the kind of the mid-America in the north, and this is where a large amount of the impacted wheat production is being felt at the moment. The red, the darkest red here, denoting an extreme drought conditions, and this was at the end of last week, and this is what's caused then this really sharp appreciation in wheat prices on the back of that. And that particular harvest, there's going to be a lack of supply because of the weather conditions. Going next down on the pecking order, if you like, you've then got the Greece Stock Exchange. Now, if you remember, there was a lot of panic about Greece a couple of weeks ago, going into whether or not they could adhere to the various austerity measures that were being imparted by the European creditors for them to get their next tranche of much needed bailout aid ahead of large July redemptions. The fact that they managed to secure that has seen the Athens Stock Exchange rally quite aggressively. And then just looking on the other side of things, two of the biggest decliners, of course, have been WTI crude and Brent. Although we have seen a pretty decent bounce in the last 5 or 6 days in crude oil from those original lows, on the month of June, they were the worst performing assets in local currency terms. This coming, of course, capturing the kind of May 25th, the OPEC meeting. We declined all the way down a good $10 or so from that initial high point at 52 when the meeting was on. And on the back of really US output continuing to increase, although we will have a quick look at that on the data that came out on Friday, and there's a couple of things to discuss there. But also a lot of people questioning the validity of the influence OPEC can have on sustaining influence on crude oil prices going forward. And so they were the worst performing assets. So quite interesting to look at these sorts of things. It kind of makes a bit of sense then why potentially you had this kind of hawkish tilt, and that was also would have played out if you're looking at the last week of data. And looking at the last week, this was one of the quite interesting graphs that I saw at the weekend. This was looking at European equity funds. And so this is a measurement of week-to-week investment flows going into different fund sectors. And what you've had here is, if you think about the reasoning, or one of the main reasons why European central banks have managed to get so hawkish in the last week, that being the ECB, predominantly I'm talking about Draghi, with that speech he delivered very early last week. But then likes of the Bank of England also following suit with Mark Carney. And one of the biggest things you've had in Europe is a subsiding of political risk. You know, we were talking a lot at the beginning of 2017 about the potential for a kind of anti-Islam politician in the Netherlands with the Freedom Party. That did not materialise. Then we had National Front, far right-leaning Marine Le Pen in France. That didn't materialise either. Now you've got a very pro-European Macron, who's been doing everything he can in order to cement a strong relationship with Germany, and that's kind of very much brought Europe together, particularly in the context of going into a negotiation with Britain. And what you've had here is a complete reversal, if you like, of fortune in terms of a lot of the risk events that many were fretting about 6 months ago have now passed without much disruption. And if you think about people's general expectation for the German federal elections now, that is, at the moment, looking like Merkel should be able to maintain her position, whereas at the beginning of the year there was a lot of risks associated with what if the dominoes started to fall in the Netherlands and France and so on. And so you've had an incredible amount of European equity funds inflow, so people shifting their equity holdings out of US funds. You've had a US withdrawal of 5.2 billion, and then you've had 2.4 billion net inflow into European funds. So European equity funds have seen investment inflows now for the past 14 straight weeks. You know, if you were looking then for what is the market seeing as the more confident play at this point, actually it's European equities that they foresee performing and outperforming US equities, despite the fact US equities are up at these kind of all-time elevated levels. I guess the play would be now is that, generally speaking, given the sovereign crisis and the various issues in the banking system that Europe's had, actually Europe is looking pretty good and actually a better investment opportunity for an equity play than it is in the US. So I thought that was quite interesting development. And then it kind of leads us into what we had last week. Obviously, these were the two guys which caused a lot of drama in the market last week. You can see here market signals both kind of waving their respective flags, and the press not really too sure what to make of it, because certainly Mark Carney flip-flopped an incredible amount between being very dovish to then being extremely hawkish. And let's just take a look at the pound and where we're sitting at the moment on the chart. And one of the most important things, I think the final outcome of last week, was that we actually managed to hold on to the large portion of the gains that we saw. You know, we rose from around 126 all the way up to 130 and above, and we're sitting above there again this morning. We're pretty flat overall in the session. I'm looking at sterling futures here. I guess on a shorter term, the upside, you got a double top from the 30th, and then, well, really that was on the same session, very late night or early Asia Pac trade, and then it was retested again very late in the US. So definitely be keeping an eye on that on the upside should we move up there to test it at any point today. And then on the downside, I guess the initial low print that defined that session at the end of last week, if we got back below S1, which is also around that 130 level. But cable, more broadly speaking, we certainly have taken a bit of a turn on the more hawkish side. I did actually see a very good comment, a way of describing this from Deutsche Bank, and they said it in one sentence. I think they really hit the nail on the head. They said, rather than looking for a reason to tighten, it feels that we've entered a period where central banks might be looking for a reason not to. It's almost like the goalposts have changed slightly now. We are on a tightening phase. The things now to track would be things like economic data, with particular focus on inflation, given that that has seen some signs of fatigue, if you like. It has been decreasing and away from target. If that continues to happen, it's going to make it incredibly difficult for these central banks to continue to deliver on a more hawkish note. Having a look at the euro, that as well saw an incredible move on the upside last week, and it's really translated into the yield curve. German Bunds as well, substantially lower last week. But looking at the rise that we had from really the 112 up to getting close to the 115 mark, it's been a phenomenal rise. And one of the things this has brought about at the weekend, some more hawkish chatter. Unsurprising, but still, it is worth noting. This is Jens Weidmann, of course, the head of the German Bundesbank. He probably is the most hawkish leaning of all the ECB members, but he said the time may be nearing for the ECB to start discussing the end of unprecedented stimulus, as growth and inflation are both moving in the right direction. So as far, and this is a similar thing that other central bankers are saying, not just at the ECB but elsewhere, is that they feel though that inflation is moving in the right direction. So although it's been decreasing, if you think about the terminology used by the Federal Reserve, for example, they're using that word transitory. So they're just seeing this as a temporary dip, and then it will gradually move back towards target. In terms of the Bank of England, a little bit different. They're foreseeing the fact that inflation will peak, and that actually there is no need for them to be in an interest rate hiking moment just yet. However, obviously that's going to be closely watched, those inflation figures. Don't forget, the problem that the Bank of England have, of course, is that an interest rate hike to counter rising inflation takes several months for it to set in and for it to start to impact or have an impact. So therefore, what they're mindful of, the reason why you had a 5-3 split, those three members looking to get ahead of the curve, not wanting to react too late, which then raising interest rates, you have to do bigger increments than 25, more like 50 basis points. And that would be, as we discussed last week, really difficult for the UK economy to handle, given the situation with negative wage growth, pressure on household incomes, and that's dampening consumer confidence in Britain, and so on and so forth. So quite a few things to have a look at. Okay, having a look elsewhere, we'll talk through some of the overnight news, and then we'll look at some of the charts as we go through. But a couple of things from overnight, and one of the things was in Japan. If you were looking at risk assets this morning, or to kind of identify what the sentiment is, well, you can see top right of my charts, gold has been edging lower in the overnight session. We're down about $7.50 going into the open. Just looking at where we traded from overnight, very early trade, we broke that kind of support level that was back on the 29th and the 30th, so the end of last week got quite a decent move below there, and also below the low point on the 26th. But in addition to weaker gold, you've also got a softer Japanese yen. So dollar yen's been moving on the upside. I guess near-term level we're keeping an eye on here, back on the 29th. So 112.57. Not too far from there at the moment, about 10 pips off that current point. But a couple of things from Japan. First off is Japan PM Abe overnight has suffered a landslide defeat in the Tokyo election. So this is not national, this is purely the Tokyo elections. The city governor, I have to apologise if I pronounce his name wrong, but Yuriko Koki, new party appearing to be headed for its biggest victory. So this party is called the Tomin First Party, and they captured 49 of 127 assembly seats. The FT this morning has reported that the result could spur then that new party to mount a similar challenge against Abe in a national election. And obviously This is all hypothetical. At this point, that's not necessarily going to be the case, but if that does happen, this would be used, these localized elections, as a precursor, if you like, to the performance on a national level. Any challenge on the leadership of Japan then leads to political uncertainty, which is usually a negative for the domestic situation. One thing, though, is that the yen hasn't really reacted to that. The yen has been more reacting to Japanese data, where you've had what is a survey-based piece of information, which is often watched quite closely in the Asian markets. This is the Japanese Tankan survey. And essentially confidence among Japan's big manufacturers hit its highest level in more than 3 years in the June quarter. This is a closely watched central bank survey, adding that signs in recovery in the world's third largest economy is gaining some pace. So pretty strong data there. May have just helped, not the currency so much, but I guess negate and neutralize some of the uncertainty on the political side. But looking at this instrument more from a risk perspective, with gold lower, the yen lower, dollar yen, if it does move higher, again just keeping an eye on that previous point of resistance towards the end of last week. But you can see here equity index futures are in positive territory. Bunds are pretty flat, but that might explain some of the just general positivity towards the open this morning. The other thing that happened as well overnight, which may have helped lift the mood somewhat, is from China. You've had the Caixin gauge showing that Chinese manufacturers are rebounding in June. Obviously still at this point a heavily manufacturing based economy, so these readings are very important. The official manufacturing PMI has outperformed the Caixin market manufacturing PMI for some time, and actually, as you well know, it's the Caixin figure that actually probably traders put a greater level of influence on, because the government figure can be somewhat subjective to some questioning about its validity, but the third party provider of market providing the more kind of transparent reading, if you like, and that importantly has got back above 50, which marks that the manufacturing sector then is back into expansionary territory. So China's manufacturing sector back into expansionary territory last month, against expectations of a continued contraction. The expectation was for something like 49.5, but the figure came in excess of 50. So that also maybe just helping lift a bit of the sentiment as well. Otherwise, moving on, one of the other things that I would say are quite unbelievable, but I guess it's not unbelievable in the new world that we live in. And this is a tweet from Donald that's come out. This is the latest one, check it out. If I just play it here. So this is a guy, this is what he's done here is he's put a graphic on the person's head as CNN, and he's giving CNN in the WWE a body slam to the floor, giving the media the smackdown. Now, this has led to quite a lot of media press suggesting that Trump has truly gone too far this time, because you know, what on earth is the leader of the free world and most powerful man on the planet doing, setting up tweets, putting graphics on people's heads with CNN on them? But from a more realistic point of view, what this does bring about is question marks about Trump's ability to go ahead and perform and execute his fiscal plan. The fact that he's having this ongoing huge battle with the media seems to be a sidetrack for him in towards getting more important, from a market perspective, plans put into implementation. Corporate tax reform, we haven't really heard a lot on that of late. Structural kind of infrastructure projects, that's become very quiet. Financial regulation, the watering down of that, again, that's something which is very snail's pace at the moment of seeing any change of that. Even the repeal of Obamacare in the Senate as well is continuing to come up against some resistance. So all the more that Trump continues to be in this war of the media, I think the market starts to get a little bit more fatigued about what it is that he can achieve. Now this comes at a really important timing now, because if you think about it, last week, if I just bring up the S&P chart, we had some really big bouts of volatility to sell the market in the S&P. Now, this is a previous significant level. You can see it quite interesting. We've come back up to that level as well. That seems at 24, 28 in the quarter to be quite important. But what I'm looking at here is a big sell-off that we had on the evening of the 27th. We then had a big sell-off on the evening of the 29th. And this is becoming a little bit more apparent. And what's happening here, I feel, is that central banks, whether coordinated or not, have definitely taken a decisive turn to being more hawkish. What this does mean then is that there's a risk that your removal of accommodative policy is going to make some investors panic. You've had such a low interest rate and a loose monetary policy environment for so long. When you start to tighten it, this leads to some fearing that you could start to then see a correction in some of these asset prices, and equities being one, which have just been on a complete one-way move onto the upside. What you're looking for here really is when you start to tighten policy on the monetary side, then technically what you would like is for the fiscal element to start picking up to supplement some of the removal of the monetary stance. However, if Trump continues to be at war with the media and not executing his fiscal plan, this then means that you're basically getting a reduction of both monetary policy stance and a lack of delivery on the fiscal side. Then you might start to see some more of this volatility, especially downside equities, might start to materialize. Buying the dip becomes an increasingly more, I'd say, risky strategy now, because last week, for the first week in a while, we've had a couple of times where the selling, when Europe has left the market, has just continued all the way into the close. You've not had that dip and then a ramp right into the close. And I think that's quite telling with the change in monetary commentary and this kind of question mark over Trump still. Quite an interesting graphic actually I saw on Trump, and this came from a research center where they surveyed something like 50,000 people about the confidence of the US president doing the right thing globally. So surveying different people from different countries to see Trump versus Obama. And if you look at Obama here scaling down, only really Russia was the negative here, and that makes sense because of the strong and severe Western sanctions that were put in place. And if you look at Trump, then his view amongst other nations is a bit of a disaster, quite frankly. The one where he is actually the highest is Russia, where, irrespective of those military strikes in Syria a few months ago, given the fact that he tried to forge a much closer relationship with Putin, has meant that Russians see him much more favourable than they do Obama. And then when Trump recently in his international tour in Israel, certainly picking sides about the whole Gaza conflict and so forth, he's become more popular than he was in terms of the US president role than under the Obama administration. The question I have here, and if you were looking at an alternate view, is, the media loves to jump on Trump's back and say, that actually possibly the guy's got mental health issues, the things that he does. And these are genuine press articles suggesting this. But actually, is this just a president who's very clever at remaining in the press, remaining relevant, and remaining relevant on social media, on media channels that actually other politicians aren't very good at using? you know, maybe this is part of the plan, and maybe it is a case of just being in the press is enough for him to remain at the forefront, and that is his objective possibly. And so what I'm saying is maybe we're just old-fashioned in looking at these types of popularity or view rankings when actually in some parts of the US Trump is incredibly popular. And so it's going to be interesting. There's been a couple of press reports this morning you might have read about. There's G20 meetings coming up. The real question mark here is, how does Trump hold himself once he's amongst China, Germany, the UK, Germany, you know, all these different countries? How does he then hold up this protectionist stance, if any? And we shall see. Certainly more to come from Mr. Trump, I'm sure, this week. Okay, moving tack to having a quick look at oil, because we've seen really interesting developments here more recently. And if I just broaden the chart out here, let's look at oil from the circle here that I had on already on the chart. This was the OPEC meeting, and so we originally dropped from going into the OPEC meeting on the day. We declined about 19%, but since that low of 19%, we've rallied over 10%. So, you know, 50% of the move, if you like, already taken back. Now, quite an interesting thing that occurred on Friday. I'm not sure whether you saw it or not, but we had 23, I think it was, consecutive weeks of US rigs coming online. So every week it was probably averaging something like 5 to 6 rigs were coming online in the US for 23 consecutive weeks. You can see here on this chart, this is the rigs count from really the summer of last year. And it's just gone up and up and up and up. Even if anything, the trajectory has got even more steeper here. Now what you can see here on the right is a slight decrease. So for the first time in a long time, you've had a decrease in rigs. Now this is interesting because what I've been reading as well is that the amount of people hedging in the market, well, let me just see if I can go back to, there was a tweet which I did last week. It's here. Producer hedging activity for 2018 has been exceptionally subdued in recent weeks as prices have pulled back below 50. What this is telling you then is that actually no one's wanting to hedge at these prices because they're of the belief now that there's no point locking in a price down below 50 when ultimately they think that the price is going to move higher in the future. Actually, it was the opposite they were doing before with US firms, locking in more like a $70 price, knowing that then for the future, if prices were to decrease, they've already hedged themselves at a higher point, so therefore they can sustain a lower price point despite the lower break even. The other thing then that this has led to is the lower that the price of oil goes, generally speaking, so when we were getting down to $42, this starts to see then a widening of the credit spreads for energy firms. What this is telling you is that actually the probability of a default on a loan that an energy company has starts to increase. That's because the price of oil is going continually lower. It's getting close to a point where actually then even the shale industry is starting to struggle at those price points. Generally speaking then, what you would anticipate to see then is that North American facilities should start to slow, plateau, or just start to flatten out going forward. We've almost hit the sweet spot, if you like. So North American crude has been going up and up and up and up and up. But then last week, if you remember in the crude oil inventory data, US output dropped a percent. US rig counts have gone down for the first time in 24 weeks. And hedging is now at this lowest point it's been in a long time. This is telling you then that actually now shale are starting to feel a bit of caution in just being full on turning the taps on, because if it goes sub 40, that becomes also problematic for them as an industry. What then we can take from this, I think, is as a whole, if you look at the beginning of 2017, this is the beginning of 2017 here, we were trading really a 55 to really, if we're looking at, let's look at the, well, really encapsulate, I guess, the first quarter. It was more a lot of the price action around this 50 to 55, certainly for the first 3 months. We then dipped, but what I'm saying now is actually I think you can look at more of a 45 to 50 type price range in the coming months, whereas at the beginning of the year we were locked in a 50-55 type price range. That seems to be the sweet spot for keeping pressure on the Gulf nations to adhere to their production cut quotas. That's going all the way through to March of next year. But then also it keeps the shale industry able to operate one of the highest amount of rigs that they've had since really 2015. Production up in excess of 9.1 million, or 9.25 million I should say. So they're making good market share, or capturing good market share. They're making good money, they're exporting more than they have done in a long period of time, and they're keeping OPEC under pressure. So I think looking for oil to really go all the way down sub 40, when we talk about, you know, where does oil go from here for the rest of the year, I really don't think that we'd be able to sustain a real move below 40. That's not unless we had an economic slowdown. Let's say then that these central banks do turn hawkish, they time that badly, and actually then that tips us back into weaker economic growth, then certainly that could change the game in this oversupplied market. But I'd say if all things remain equal, then I'm looking for really more of a 45 to 50 as a more of a longer term price band, if you like. Okay. Finally, Brexit. What's the latest? UK drops Brexit bravado as Hammond tells CEOs May will listen. I think for me this is really the most unsurprising turn of events. I always thought that hard Brexit was just nonsense. I thought it was more of a just angling of a campaign to cajole what Theresa May thought was a lingering sentiment from the vote to leave the EU. She obviously got that spectacularly wrong, but once you pin your kind of name to a certain stance, very difficult to make a U-turn. But ultimately, really going into these negotiations, it's Europe that have the upper hand, and a concession on the side of the UK to soften its stance, I think, is as to be expected. So Theresa May's government has changed its tune on Brexit, striking a more sombre and realistic tone after the election. And so today, the Chancellor, Philip Hammond, who you can see here, will give a speech to the CBI, that's Confederation of British Industry, to tell business leaders their concerns over the split will not be dismissed. It's a conciliatory gesture to an audience that's been overlooked at times, even dismissed. So the CBI is obviously looking at the business community. He is the Chancellor. As Chancellor, as a role, his objective is to safeguard the soundness of the economic performance of the UK. So it's unsurprising that he would want to be leaning towards access to the customs union, paying for the single market, and so on and so forth. So at the moment, cable, I would say, not too much influence on certainly these comments, but something to just monitor going forward. I would say over the last week, what's been interesting is that Bank of England talk has superseded actually the Brexit situation, given the mixed signals from Mark Carney. But we are currently now in a hawkish kind of phase, if you like. Okay, to round up things, quick look at the calendar. One thing to keep in mind for today is when we get into the afternoon session, particularly late on, just be mindful of your duration of trading strategies if you're going to be in an open trade or in a position, because tomorrow is the 4th of July and it's one of the biggest holidays in the US calendar, and what it generally means then is all the markets in the US are closed on Tuesday, and they normally means that US participants will leave their desks early today, if not won't be in today at all. So actually you might get a fairly quiet afternoon in that respect. Looking at the actual calendar for today, we'll go into the specific day one shortly, but quite interesting, you've got Carney speaking as well today. Whenever he speaks, I'd say you've got to be listening at this point. But data, I would say as a whole, takes almost a new realm of significance, because like you heard from ECB's Weidmann, it seems as though the ECB want to get into a more hawkish stance. The only thing that can stop them maintaining that and delivering on a hawkish turn would be if the economic data starts to sour. And so economic data almost takes on a new realm of significance again. So you've had a couple of the manufacturing PMIs this morning, slight miss in the Spanish number, the Italian number pretty much in line, the French number just a very minor miss, the German number stronger than expected, 59.6. Looking out for the UK number in about 20 minutes time. You've got the US bank holiday on Tuesday, so actually Tuesday could be quite a quiet day overall, but overnight for the FX traders you do have the RBA interest rate decision. Wednesday you have the overnight, you've got the Chinese service sector update on the PMIs. You've also got, in particular with very high importance, will be the UK service sector, given our high gearing towards that part for the performance of our GDP. You've also got the FOMC minutes in the evening. Thursday, this is really then on Thursday you start to get the build up for Friday's release of US non-farm payrolls. So you get the private employment number, ADP. You've also got US trade balance, the weekly jobless claims, ISM non-manufacturing. We'll be looking out for that job component as well. And then going through into non-farms, which finally comes on Friday. Quite interesting here, on Friday you have Carney. You've also got lots of Fed speakers, Stanley Fischer, obviously the vice chair, Williams Powell. You've got ECB speakers listed in throughout the week. So central bank commentary, economic data, should be a pretty interesting week, but it might be more geared towards the second half of the week when the US come back in terms of the bigger outright market moves that we may see. Okay guys, gonna wrap it up there. Any questions, of course, just let me know in the chat room. Otherwise, have a good day. And thank you very much.